Hello students. Today we will discuss about IFRS 11, which is related to the joint arrangements. It outlines the accounting by entities that jointly control an arrangement. Joint control involves the contractually agreed sharing of control and arrangements subject to joint control are classified as either a joint venture or joint operation. IFRS 11 was issued in May 2011 and applies to annual reporting periods beginning on or after 1st January 2013. The core principle of IFRS 11 is that a party to a joint arrangement determines the type of joint arrangement in which it is involved by assessing its rights and obligations and accounts for those rights and obligations in accordance with that type of joint arrangement. Let's discuss about the key definitions used in the IFRS 11. Joint arrangement. An arrangement of which two or more parties have joint control. Joint control. The contractually agreed sharing of control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. Joint operation. A joint arrangement whereby the parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to that arrangement. Joint venture. A joint venture arrangement whereby the parties that have joint control of the arrangement have rights to the net assets of the arrangement. Joint venturer. A party to a joint venture that has joint control of that joint venture. Party to a joint arrangement. An entity that participates in a joint arrangement regardless of whether that entity has joint control of the arrangement. Separate vehicle. A separately identifiable financial structure, including separate legal entities or entities recognized by statute, regardless of whether those entities have a legal personality. Now let's discuss about the joint arrangements. A joint arrangement is an arrangement of which two or more parties have joint control. A joint arrangement has the following characteristics. The parties are bound by a contractual arrangement, and the contractual arrangement gives two or more of those parties joint control of the arrangement. A joint arrangement is either a joint operation or a joint venture. Joint control. Joint control is the contractually agreed sharing of control of an arrangement, which exists only when the decisions about the relevant activities require the unanimous consent of the parties sharing control. Before accessing whether an entity has joint control over an arrangement, an entity first assesses whether the parties or a group of the parties control the arrangement. After concluding that all the parties or a group of the parties control the arrangement collectively, an entity shall assess whether it has joint control of the arrangement. Joint control exists only when decisions about the relevant activities require the unanimous consent of the parties that collectively control the arrangement. The arrangement for unanimous consent means that any party with joint control of the arrangement can prevent any of the other parties or a group of the parties from making unilateral decisions about the relevant activities without its consent. Types of joint arrangements. Joint arrangements are either joint operations or joint ventures. A joint operation is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. Those parties are called joint operators. A joint venture is a joint arrangement whereby the parties that have joint control of the arrangement have right to the net assets of the arrangement. Those parties are called joint venturers. Classifying joint arrangements. The classification of joint arrangement as a joint operation or a joint venture depends upon the rights and obligations of the parties to the arrangement. An entity determines the types of joint arrangement in which it is involved by considering the structure and form of the arrangement, the terms agreed by the parties in the contractual arrangement, and other facts and circumstances. Regardless of the purpose, structure, or form of the arrangement, the classification of joint arrangements depends upon the parties' rights and obligations arising from the arrangement. A joint arrangement in which the assets and liabilities relating to the arrangement are held in a separate vehicle can be either a joint venture or a joint operation. A joint arrangement that is not structured through a separate vehicle is a joint operation. In such cases, the contractual arrangement establishes the parties' rights to the assets and obligations for the liabilities relating to the arrangement and the parties' rights to the corresponding revenues and obligations for the corresponding expenses. Financial statements of the parties to a joint arrangement. Joint operations. A joint operator recognized in relation to its interest in a joint operation. Its assets, including its share of any asset held jointly. Its liabilities, including its share of any liabilities incurred jointly. Its revenue from the sale of its share of the output of the joint operation. Its share of the revenue from the sale of the output by the joint operation, and its expenses, including its share of any expenses incurred jointly. A joint operator accounts for the assets, liabilities, revenues, and expenses relating to its involvement in a joint operation in accordance with the relevant IFRSs. The acquirer of an interest in a joint operation in which the activity constitutes a business as defined in IFRS 3 business combinations is required to apply all of the principles on business combinations accounting in IFRS 3 and other IFRSs, with the exception of those principles that conflict with the guidelines in IFRS 11. These requirements apply both to the initial acquisition of an interest in a joint operation and the acquisition of an additional interest in a joint operation. A party that participates in but does not have joint control of a joint operation shall also account for its interest in the arrangement in accordance with the above if the party has rights to the assets and obligations for the liabilities relating to the joint operation. Joint ventures. A joint venturer recognizes its interest in joint venture as an investment and shall account for that investment using the equity method in accordance with IAS 28, investments in associates and joint ventures, unless the entity is exempted from the applying the equity method as specified in that standard. A party that participates in but do not have joint control of a joint venture accounts for its interest in the arrangement in accordance with IFRS 9 financial instruments unless it has significant influence over the joint venture, in which case it accounts for it in accordance with IAS 28. Separate financial statements. The accounting for joint arrangements in an entity's separate financial statements depends on the involvement of the entity in that joint arrangement and the type of the joint arrangement. If the entity is a joint operator or joint venturer, it shall account for its interest in a joint operation in accordance with the paragraph 20 to 22. A joint venture in accordance of IAS 27 separate financial statements. If the entity is a part that participates in but does not have joint control of, a joint arrangement shall account for its interest in a joint operation a, in accordance with IFRS 9 unless the entity has significant influence over the joint venture, in which case it shall apply IAS 27. Disclosure. There are no disclosures specified in IFRS 11. Instead, IFRS 12, disclosure of interest in other entity, outlines the disclosure required. In case of applicability and early adoptions, when IFRS 11 is first applied, an entity need only present the quantitative information required by IAS 8 for the annual period immediately preceding the first annual period for which the standard is applied. In case of special transitional provisions, they have included for transition from proportionate consolidation to the equity method for joint ventures, transition from the equity method to accounting for assets and liabilities for joint operations, transition in an entity's separate financial statements for a joint operation previously accounted for as an investment at cost. In general terms, the special transitional adjustments are required to be applied at the beginning of the immediately preceding period. However, an entity may choose to present adjusted comparative information for earlier reporting periods and must clearly identify any unadjusted comparative information and explain the basis on which the comparative information has been prepared. An entity may apply IFRS 11 to an earlier accounting period, but if doing so, it must disclose the fact that it has early adopted the standard and also apply IFRS 11. This is all about IFRS 11. I hope the points are clear to everyone. Thank you very much.